Today I'm sharing the easiest 5-minute scalping strategy out there. I found it a while ago and ever since then I've always used it in Forex. It's perfect for day trading because it simplifies price action, clearly shows chart setups, and helps you enter and exit trades with full confidence. I'll even show you a ton of scalping examples so you'll know exactly how this easy scalping strategy works and start making money in the Forex market consistently. So here's a simple step-by-step scalping strategy I've perfected over the years. First, we use the 15-minute chart to clearly identify market trend. To keep things clear and consistent, I like to use two indicators, which is the 20 and 50 simple moving averages. These two moving averages instantly show us market's momentum and help us identify the overall market direction quicker. Next, we want to pinpoint supply and demand areas. Now, you can do this on the 15-minute chart or the 5-minute chart. I typically try to find a supply and demand on both. However, in this case, currently we don't have a clear one, so let's move on to the 5 minutes. On the 5-minute chart, we can clearly see a nice demand area just over here. For those who don't know, this is a drop, base, rally. We are always looking for fresh zones that haven't been touched. We also want to have a slight imbalance in the market. So this little imbalance over here, which means the market orders were not filled in this area. Likely there's going to be a retest down to fill that area zone back to the demand zone before we see a continuation for the market move. Then simply we wait for the market to drop down. 1, 2, 3, and 4. Stop loss has to be just below the demand zone, maybe even covering the 50 moving average if it's trending towards the upside with you, and take profit has to be double that. Click confirm, we enter our trading position and we make our money. So not much guessing, no complicated indicators, just clean price action. So now let's break down this step by step so you can easily follow along, because with trading there's a ton of nuances that you need to understand. Okay, so step one is very important. We want to identify the trend on the 15-minute chart. So what counts as a good bullish trend and a good bearish trend? A good bullish trend will look something like this: a strong momentum for the candlesticks going towards the upside, and the two moving averages, the 20 and 50, have this little gap over here. We do not want the candlesticks or moving averages to be something like this. This is not a trending market. It's quite choppy. The moving averages are in between the candlesticks. That's not a great move. And the angle of the moving averages is not trending up. We want a pretty solid steep trend making new highs every single time by the candlestick. Since, you know, moving averages lag, they are a visual helper for you to identify the trend, and the best way forward, as I said, is to look for a gap that's going up. So for a bearish trend, I would say something like this, where it starts to dip down, is great. That's what you want to be kind of looking for. Somewhere in this window, not something like this, still not trending, still chopping, but once it makes that new, you know, low, as you can see, low, low, low again, bam, 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 that's what we are looking for, the bearish trend. Okay, after we identify the trend, we need to find supply or demand. In this case, we want to find a demand because the trend is going towards the upside. So typically a demand zone is going to have an imbalance as well. This is what a imbalance looks like, because there was no previous wick in this area zone. As you can see, it pushed the market further up, left this imbalance over here for the price. Some people will call this a fair value gap, which is fine, but in price action terms, it was always called a imbalance. So that is what we are looking for. But we don't actually trade the imbalance. What we actually trade is the demand area, right? So the demand zone would be over here. This is at the top of the wick, as you can see, you mark it, and at the bottom of the wick, you mark it. And this is because it's a rally base rally, right? You can understand more of this in the video here. I'm not gonna go in full detail. I actually made the full guide. But what you need to know, there is a wider version and a preferred version. A preferred version, something like this, is what you want to be aiming for to enter your trade. So we have an imbalance, we have our demand area on the 15-minute chart. Now we want to wait for a rejection towards this area zone. So we are currently in an imbalance. Look, goes down, goes up, touches it. This is where we would want to enter our trade. Why? Because the demand was fresh. So this was a fresh demand area, was never touched before. It was struggling to touch it here, here, here. Boom, it touched it. That was where the 50 moving average was also at. So that would be an extra confluence. So somewhere around here where the wick is dropping down, you don't need to wait for a candlestick closure. Whichever price you get it, you enter and you obviously take your profit. 1 to 2 risk to reward. Definitely aiming for the highs just over here. After the high is reached, you should be expecting some sort of selling pressure because clearly this would have been a supply zone over here. This would be the wider version. This would be the preferred version. So let's see what actually happens. And it actually breaks through it because it's a counter trend. Supply and demand really works great on a trending market, but it can work really bad if you're trading a reversal without higher time frame context. This is why you would have to take your profit here, take a partial, move your stop loss to entry, whatever is necessary for your own risk management. You have to take profit. Nearly forgot, there's also another thing that you want to be looking for. It's called a equilibrium. So if we come back to the chart, something like this. This is a swing low. This was a swing high. Let's say we didn't see this one, whatever. We use our Fibonacci tool, not because we want to be using the lines 382 or 618, but because it's the middle, it's the equilibrium. That is the fair price. And markets typically retrace around the 50% level. So if we have a swing leg towards the upside, here, or obviously here was the top, let's say we mark that one. The pullback is likely going to be somewhere over here, which is the 50% of the market move, because the market is trending up. If the trend continues, it's not going to break out, past the one level over here, because if it does, the trend's changing. But if the trend continues, 50% equilibrium is fair price for the institutions to enter and continue the trade. So they push the market up, wait for the market to retrace back in the 50% line, and then you enter your trade long. And this is the best situation that you want. You have the equilibrium, we are inside it, we have our demand zone over here, we are covering the 50 moving average with our stop loss, and we are aiming for the top over here. Also, this is a 5-minute strategy, so we need to look at the 5-minute chart as well. And the 5-minute chart, obviously, we want to kind of fine tune everything, and we want to get the best possible entry we can. So what we can do is mark our previous demand zone on the 5-minute time frame. And as you can see, in this case, there was a drop, little base, and rally towards the upside. This is the zone I would be marking on. So basically my little trigger. Since sometimes when you mark demand or supply zones on the higher time frames, you might have a really big stop loss, right? If we, let's say, entered our trade off, this area zone over here, look at this. At the top, already 9 pips. Maybe we have to cover 13 pips. For scalping, that's quite a lot, right? So we may not want to do that. We want to wait for that ideal pullback. And the ideal pullback would obviously be this area zone over here, which it touched on the 5-minute time frame, which is our trigger entry. We analyze on the 15-minute, try to find, solid demand zone there. Then we go to the 5-minute and kind of fine tune everything where we can actually enter to maximize our pip gains and actually make our risk management way more precise. So let's say we are covering this area zone, we can, make it much less over here. If we entered our trade, somewhere where the candlesticks actually touch our little 5-minute demand, so our risk to reward immediately becomes from 1 to 2 to 1 to 3 risk to reward, which means if we are risking $100, we are probably aiming to profit $300, which is even better. So now if you're still confused, let me show you some real-time examples, trades I actually took, what I was thinking in the moment. There's certain situations, certain things that could be happening that you don't know what to do in that type of situation. So let me show you. Okay, so here's an interesting example. We are currently on the 5-minute time frame. We clearly see a demand zone over here. Clear demand zone. This is what we want to trade. We can obviously do the wider version and the preferred version. On the 15-minute chart, the market is currently kind of chopping, trending towards the upside. However, it made this nice, again, demand area zone, and I sometimes use the 1 hour chart just to kind of see what's actually happening, and as you can see, it's trending up as well. This is not typical, but if I see the 15-minute is chopping, at least I want to look at the hourly time frame to see what the hell's going on further, you know, in the further context a little bit better. But the main thing, a clear solid demand on the 15-minute and the 5-minute chart, right? What else is going on? Well, we have this imbalance over here. Boom. As you can see, it was never touched. Later, obviously, it touched it a little bit, but it never broke out through the candlestick, which means the gap is still valid until it actually breaks out. Once a imbalance is touched, you typically should expect some sort of, you know, movement or breakout towards the upside, downside. You know, you don't trade off it, you trade off demand areas, but to have it as confluence inside your demand is really, really good as well. And since it's fresh, never been touched, even better. So if we see this situation over here, we need a pullback, right? We know that the market is trending towards the upside on the hourly. 15-minute low chopping over here, broke out, looks good. What can we do? We can actually use this tool over here to find our equilibrium, right? So our equilibrium is pretty much sitting in the demand area zone. So this is perfect. We know that if the market continues trending like on the 1 hour time frame, you know, making new highs every single time, we should be expecting that 50% move, you know, happening somewhere sometime soon. So let's see what happens in this case. 1, 2, 3, and 4. We have a nice push towards the upside, and we actually reached our wider version in demand. We did not reach the preferred version over here. We were a few pips away, but I would personally enter this trading position on the wider version just because it has it on the 15-minute chart and the 5-minute chart. And we also have the imbalance, so you want to cover everything with your stop loss. Something like this would do. You are aiming for the high over here, so it wouldn't give you the best risk to reward. But in this case, you don't have a clear supply area. You had one over here, but it was touched multiple times. Look at this. 1 touch, 2 touch, 3 touches. Now it has been filled, which probably means it's not gonna hold, since the overall market trend is also going towards the upside. So you don't want to be scared too much after it has been touched and filled. You know, if the zone is fresh, it's a different situation. You want to be a little bit cautious. So let's see what happens. It does respect the area one more time. Look at that sharp move towards the downside, but overall the market continues going towards the upside. You could obviously then, you know, target big area zones over here, but I would personally probably just close off my trade. It's not the greatest risk to reward, 1.32, but it doesn't really matter because the setup was great. I would personally take this setup even with this kind of risk to reward. You take what the market can give you. And personally, I really like this situation, so I would have taken this trade 10 times out of 10. So here's another example that's totally different. Look, there's a demand zone on the 15-minute chart, dropping back down over here. On the 5-minute chart, what can we see? A nice bearish engulfing candlestick, nice base, bullish engulfing candlestick leaving the room. Obviously, this is a nice sign that likely there's going to be a demand zone somewhere over here. So you should be marking the base on the 5-minute. So that's what we can do. Mark this out here. Let's say the wider version. And this is where you should be expecting, you know, a push towards the upside. Maybe over here, as the preferred version would be better. So you could have potentially entered your trading position somewhere over here, you know, covering everything and targeting here. But what happens is it goes towards the downside. Now, the reason I showed you this is because the strategy is not 100% foolproof. It can lose and it does lose. However, there was a problem with this trade. The imbalance over here was very small and it was filled with this candlestick. And further, we didn't have another imbalance, and this was a problem. So if you took this trade, which the imbalance was filled when you took it, it's not a good idea. As I said, there has to be an imbalance and a demand area zone. If you don't have it and you just simply look for these demand and supply area zones, they're everywhere and you're not gonna have a great time. You need to filter, filter, filter. And once you understand how to filter your trades properly, you will start realizing how good this scalping strategy actually is. We can even look back actually. Look at this institutional level over here. This is clear institutional push. You know, they really like this price for whatever the reason, and you could have potentially marked this demand zone. Look at this. Y diversion somewhere over here and took this trade after it touches this zone. So look at this. It's dropping down, yes, on the 5-minute, but markets move in supply and demand. Look at this. It touched over here. What happened? Look, it's struggling. It's going, consolidating, starting a new trend, going towards the upside. Do you see what I'm talking about? You want to fight institutional pressure, and the bigger the candlestick, the better the supply and demand, clearly. So obviously when we're looking at the 5 and 15-minute charts, it's not going to be as big, but you are trading with the trend and other types of confluence, the imbalance, the 50 moving average, whatever. So this is why, little supply and demand areas work. But if you're going to be trading, just supply and demand randomly, it's never going to work because you're going to lack context and confluence. Now, obviously, sometimes you're going to be in these situations where there's a nice bullish engulfing candlestick. Obviously, we clearly can mark the previous demand zone over here. This is the 5-minute time frame. Look at this nice little demand area zone as well. You want to enter your trade once it reaches the 5-minute demand. So something like this, you're covering pretty much the 5-minute demand only, just to kind of make your stop loss a little bit less. I mean, the stop loss ain't too bad over here, so I might as well cover the big demand on the 15-minute time frame as well. 2-to-1 risk to reward, obviously somewhere over here. Take some profit, but there's no clear supply over here as well. That's something to mention, so it probably will break out. So 2-to-1 risk to reward, something like this. We would enter our position after it touches this area zone, but look what will happen sometimes with this strategy. It doesn't touch it. You see, there was a wick. So if you had a limit order or something to buy over here, it didn't touch it. Look what happens. It goes towards the upside and it's, shatters your heart because you see you could have made, for example, $1,000 or something. But obviously you didn't because you missed your entry. Now, there's a saying in Forex, don't be a dick for a tick. So if you see it somewhere nearby, near your entry, you can enter your trade. Maybe if it's, let's say, what is it, half a pip. If it's half a pip away, you can move your entry a little bit. It's not going to be earth shattering that you entered your trade a little bit earlier. It's fine. So if you enjoyed this scalping strategy, make sure to give it a like. You can always join my trading group, link down in the description below, and I recommend everyone to watch this video next. You'll probably enjoy it. Take care, Lions. Have a wonderful day. Stay safe and goodbye.